Hi, good morning. Welcome to Morning Kappa. Here we come to week 1 of July with futures. Before we begin, I would like to highlight a brief disclaimer. Trading in futures and options involve a high level of risk due to leverage and may not be suitable for all investors. This presentation is intended for educational and informational purposes only and does not consist of an invitation or recommendation to buy or sell any financial instrument. Please consult your licensed broker or financial advisor before making any trading decision. All right, let's start. The global market has transitioned into a highly defensive and restrictive stance moving into week 1. The broad risk-on environment that previously fueled major Western equity indexes has cooled off significantly. From the table, all major global indices and agriculture boards have slipped out of their active bullish cycle, resulting in a heavy concentration of neutral and negative short-term trading profiles. For local markets, FKL and FCPO remain in neutral short-term phases with very low directional conviction. In Asia, the Hang Seng Index showed sharpest decline on the equity board, breaking down from neutral into negative this week. Meanwhile, China A50 remained locked in a short-term neutral holding pattern for consecutive weeks. In the US market, a major shift has occurred. The Nasdaq, S&P 500, Dow Jones, Japan Nikkei 225 have all descended from their fully positive week 4 trading profile into a neutral stand. While their long-term overall trend remained positive, immediate upside momentum has flattened as investors aggressively lock in profit as historical highs. In the grain complex, both corn and soybean have broken down from neutral into negative, indicating that seller has regained full control of agriculture complex. Meanwhile, soybean oil has remained in a neutral profile. For metal, gold remained pinned to a negative trading profile across both weeks, joined by silver, which slipped from neutral to negative this week. Rising global bond yield and fading geopolitical panic continue to weigh on non-yielding safe havens. Copper stands out as the unique alpha asset on the board, breaking out from a neutral into fully positive. It continued to be supported by strong underlying industrial demand. Crude oil remained quietly neutral, with structural supply floor preserving its long-term positive trend. Natural gas also continued to hold a neutral stand. Well, the market that's on our radar is gold. Gold weakened below USD 4,000 an ounce on Tuesday, marking its lowest level in nearly 8 months. It was on track for 4th consecutive monthly decline at Middle East uncertainties and expectation that U.S. Federal Reserve will raise interest rate this year. Investors are now awaiting the latest U.S. monthly employment report for fresh clues on the policy outlook. Meanwhile, the United States and Iran are scheduled to resume peace talks in Doha, Qatar this Tuesday. Although prospects for a lasting ceasefire remain unclear, the chart shows a strong macro bullish trend that began in mid last year, accelerating sharply into late 2025 to early 2026, where it reached an all-time high of 5626. Following this peak, the market shifted into a defined bearish markdown phase, marked by a sequence of lower highs and lower lows. At present, gold is attempting to break below USD 3,935 after being rejected at the resistance of 4430 and 4120. The next upper level to monitor are 3935 and 3818. The next product on radar is WTI crude oil. Futures recently fell below USD 70 per barrel as investors weigh the prospect of a US-Iran summit in Qatar following days of back and forth fighting around the Strait of Hormuz. Although crude oil has returned to a pre-conflict level, underlying pressures in the oil market remain. recently the escalating tension in the Strait of Hormuz have slowed the flow of oil tanker through the strait. Crude oil also found support on Monday from a weaker dollar and strength in equity markets. As a result, prices are currently hovering near the key support level of USD 69.3. If this level is breached, the next support to monitor is 66.31. However, the key level 69.3 is supported. The near resistance is 72 and 76.74. Okay, before we look ahead, let's audit last week. We had one in position and a floating position with a floating profit and one call with realized loss. Micro copper triggered the reference price last week, and we shall see if the market could travel further. And the second market outlook was soybean oil. The price failed to support and trigger the potential loss price. So this is out of the position. Well, as usual, the highlight of our briefing, the future market call. Building on last week's momentum, we are anticipating a potential opportunity in FKLI. The initial investment is 4,000. Short-term chart setup is positive. Reference price is 1670.5. Potential profit price is 1693. Upside potential of 1,125. Potential stop loss price below 1660.5, capping potential loss at -500. The next product is the second call is micro gold. The initial investment is 2244 USD. Short-term chart setup is negative. Reference price is 4040. Potential profit price is 3950, capping upside of USD 900. Potential stop loss price below above 4070, capping the potential loss at USD 300. So if you like what we are sharing, there is never better time to start. We have just rolled out a brand new client exclusive initial call, the AM/PM market guide, designed to help you to navigate FCPO intraday move with precision. If you are completely new to futures market, we have also got you covered with a TWP 2.0 campaign, which is a futures campaign to get you started in futures trading, which give you up to 500 in zero brokerage trading to help you start your futures trading journey. Well, if let's say you are ready to dive in, get in touch with us and drop us an inquiry on the RHB Invest website today. And if you sign up, every trade that you place will also automatically qualify you for trade and win lucky draw entries, giving you a chance to win a Tesla or take away the monthly prices of iPhone 17. Well, if you are from JB, we are delighted to invite you to an exclusive physical event entitled Futures Insight on 18th of July 2026 in JB Holiday Inn, where three special guest speakers from CME, David Low, Joseph from RHB Head of Retail Research, and myself will share insights on the market trend, trading technologies, trading opportunity, and strategies to help you navigate today's dynamic environment. Don't miss out. I think that's all from me. Thank you for your time, and we'll hand over to the next speaker. Thank you very much.
Right, morning everyone. Welcome back to Morning Kappa at 8. So today is the 1st July, right? Today is the public holiday in China, Hong Kong and China, right? But nonetheless, looking at the Hang Seng Index, it made a rebound just before the market closed for holiday today, and the rebound was led by SMIC, Semiconductor Manufacturing International, Zhongxin Guoji stock code 981. You can see that among the blue chip stocks in Hong Kong market, 981 have rebounded by 5.4%. In fact, look at the share price. Currently is trading almost at a 2 weeks high right now. So um, among the tech stocks, SMIC managed to stage a breakout. Now, secondly, we also see that the Lenovo is playing a catch-up. It has been undergoing a corrections for the past 1 month. But yesterday, right, the Lenovo managed to climb higher, eyeing to resume on the upside movement. Now, meanwhile, the A50 index has been moving up for the third consecutive sessions yesterday. You can see that the market sentiment has become risk on just before the Hong Kong market closed on the 1st of July. At this juncture, look at the the China market, 725 has extend the upside movement. So take a look at the 725 Jing Dongfang, right? The stock code is 725, right? It has managed to break past the um 850 renminbi, heading towards 9 renminbi 10 cents, and followed by 970. Downside support is 790, right? Then on the looking at the S&P 500, it also managed to um, re reclaim the territory above the 20 days moving average. So in terms of technical setup, right, the SPX have grown much stronger right now. So on the upside, we are waiting to see the S&P to break the 7,005. If that happens, right, the sentiment on the S&P will be boosted, and can see that more upside movement from here. So yesterday, looking at the XPX stocks across the market, I can see that the um, traders are going after the memory counters again, and we do see that the front-end equipment suppliers such as the AMAT and Lam Research have moved up by 4 and 5%. Now, the other sector that I would like to highlight to you is GE Vernova, GEV, right? The stocks have staged a breakout and moving up steadily. So in our reports about 2 weeks ago, we have highlighted GE Vernova, and right now the shares has break past 1,120, right? And GE Vernova is a company under the GE, and they also have the project that related to a nuclear power. So on the GE Vernova, they are moving towards 1,240 and followed by 1,350. So downside support will be this 1,000 mark, and then on. Now another data center or power related theme would be the Vertiv, that the share price have staged a very strong rebound. So coming this week, you'll be eyeing to stage a breakout on the 340 US dollar resistance, and followed by next resistance at 370, and followed by 400. So downside support is at 310. Secondly, that another sector that I've mentioned to you earlier of the week would be the cybersecurity sector. So in terms of cybersecurity sector, there will be two leaders. Firstly, the CrowdStrike, and the other one will be Palo Alto. So Palo Alto, the stock code is PANW, and you can see that the shares have been trading on the multi-months high right now. Yesterday, it just break past 330 US dollar, and heading towards 360, and followed by 390. So downside support is 310, and as for the local market, so FKLI is consolidating just near the 20 days moving average. So downside support firmly at 1650. I will stay on the bullish bias as long as FKLI stay above 1650. Now, meanwhile, the FCPO turned lower yesterday, falling below the 50 days moving average. So in terms of technical setup, that's some weakness to be seen in the FCPO. So on the upside, immediate resistance is 4,006, followed by higher resistance at 4,007, right? And as for the trading stocks this morning, firstly, we look at the Binastra that break above 2 ringgit and 5 cents. Next resistance will be 2 ringgit 20 cents, and followed by 2 ringgit and 35 cents. Downside support is 1 ringgit and 90 cents. And then on we have IAB, Sarawak-based company. insight analytics that break past 1 ringgit and 50 cents on the back of a high volume. So after a breakout, IB will be testing that resistance as 1 ringgit and 60 and followed by 1 ringgit and 70. Downside supports market at 1 ringgit and 40. So we have both breakout stock this morning. Firstly, Binastra and followed by IAB. So thanks. I'll stop here and pass on to next presenter, Eddy. Thank you.
Thank you, Joseph. Hi, good morning, everyone. So for me, we have a report which is on Sunway Healthcare. This is a initiation report. We are initiating Sunway Healthcare with a buy DCF derived target price of 2 ringgit and 14 cents, which is 18% upside. So in short, Sunway Healthcare runs 5 hospitals, and it's anchored by Sunway Medical Center, Sunway City KL. Right, that is the hospital which is Malaysia's largest top-ranked private quaternary hospital that offers a wide variety of subspecialties and specialist treatment. The core of our thesis here mainly lies with the group's formidable competitive advantage, which includes strategic focus on Congo specialties, which is cardiology, oncology, neurology, gastroenterology, and orthopedics, right? That actually leads to higher bill sizes as well as it attracts foreign patient flows. Number 2 is basically it's a unique vertically integrated ecosystem, which can be seen as a demand mode that mitigates some of this primary risks of building new hospital. Right. Number 3, we have here it's a robust relationship with insurers, which provides them with a competitive edge in terms of patient footfall. Right. So the primary execution risk for scaling greenfield healthcare assets is that it typically takes about 3 to 5 years of loss-making gestation period. But for SunMed, they have actually structurally broken this trend with all of its tertiary hospitals achieving EBITDA positivity within their first 12 months of operations. So this proven ramp-up velocity provides support to our 3-year EBITDA CAGR growth of 22.2%, 3-year CAGR as in 2025 to 2028, right? That actually outpaced both local peers and as well as the regional peers by 2 times and 3 times. And in terms of our forecast for PATAMI, 3-year wise, we are looking at 25.9%. This will be underpinned by ramp up of new hospitals that commenced operation in the past 2 years, and brownfield expansion at its operating hospitals. Also, we just want to note that we have not fully accounted for potential tax effects. Something like recognition of investment tax allowances for its newer hospitals that could affect tax rate in the forecasted period. So there's upside from that. And our target price of 2 ringgit and 14 cents actually implies EV/EBITDA of 30.6 times. This is a calendar year 27 EV/EBITDA, which is at a premium to Malaysian as well as regional peers. But this is all done while maintaining valuation discipline against its India peers. We do believe that this appropriately captures Sunway Healthcare's structural growth profile, its brand premium as well as defensible earnings visibility. And from a growth adjusted basis, we do not view our valuations as excessive. So aside from that, they are also a core FVM KLCI component. Combined with a tight free float of less than 18%, that actually kind of drive institutional scarcity premium. Its domestic-centric defensive operation actually also fits seamlessly into our broader defensive market narrative, which offers a structural safety net. So in terms of risk-wise, this would include major delays in realizing its expansion plans, margin pressures, as well as unfavorable regulatory developments. But all in, initiating coverage with a buy with a DCF target price of 2 ringgit and 14 cents. That's all from me. I'll pass on to our next presenter, Max. Yep. Thank you.
Thanks, Eddy. So we have a report on YTL Power. We have We maintain our buy call and upgrade our target price to 6 ringgit. This presents about 44% upside with about 2% yield. What we have done is essentially we have increased our data center capacity built up for that results in our increase in target price. The YTL Power has now basically contracted about 208 megawatts capacity and is looking to build another 260 capacity by end of calendar year next year. Our TP reflects this stronger DC rollout as well as stronger revenue contribution. Essentially, they are also building basically about 3 new data center halls, and they are targeting to contract about 200 megawatts capacity to reach about 1.2 gigawatts of capacity in Johor. This is much more the stronger sort of target compared to about only 600 megawatts last year. And this is largely driven by the robust demand that's still coming from hyperscalers for data center halls within Johor as well. Aside from that, YTL Power is also looking to expand their data center capacity in the Klang Valley, ASEAN, as well as the UK. For the Johor site, they are building up to 600 megawatts of solar, which will help to reduce in terms of their costs, electricity costs, with already 200 megawatts already currently operating as well. The other thing to look up for YTL Power as well is the potential IPO of its data center business, which could happen next year, which will help to further unlock and monetize the value in the data center. Assuming sort of a 20 times EV/EBITDA multiple on the data center business, we estimate about 3 ringgit 6 cents sort of valuation for the data center business. This presents about 12% upside from our current SOP. Do note that 20 times EBITDA is reasonable considering that the other two players are going to the market, meaning AirTrunk as well as Day One. They're also looking at roughly about 20 to 23 or 25 times EBITDA multiple, which is sort of valuations we were looking at when you're listing the data center. So all in, we still maintain our buy call for YTL Power. I think we're still one of the best, one of the top picks for the utility sector within Malaysia. I'll stop now and I'll pass on to the next speaker.
Hi, morning. Thank you, Max. So I'll move on to Petronas Chemical. It's a company update. So just an update is that while Petronas Chemical near-term earnings may be tempered by lower urea prices and plant turnarounds, we believe these headwinds are temporary. More importantly, the potential divestment of its 50% stake in Pengerang Petrochemical Company, PPC, could remove a key drag on structural earnings, reduce FX volatility, and unlock shareholder value. These factors underpin our more constructive view on PChem following its recent share price pullback. So more on some data is urea prices have retraced to $407.5 per ton, while the year-to-date average is $615.6 per ton. As geopolitical supply risks have moderated, and additional export from China should alleviate the earlier tightness in supply. Nevertheless, we expect urea prices to improve in second half 2026, supported by seasonal fertilizer demand. Meanwhile, methanol currently last price at $552 per ton versus the year-to-date average of $505.88 per ton, and ammonia $770 per ton versus the year-to-date average of $640.20 per ton. So this remains resilient, cushioning the impact on companies' fertilizer and methanol segment, while the urea is looking at a weakness at the moment. So second quarter FY26 likely represent an earnings high. We expect the PChem to capture the bulk of the recent petrochemical pricing upcycle in second quarter 26, with stronger realized ASPs more than offsetting lower utilization from plant turnaround at the ASEAN Bintulu fertilizer and Kerteh plants. Looking ahead, earnings should gradually normalize as regional production gradually resume. Supply chain recovers and war-related pricing premiums unwind with a lag in realized ASP. So more about the PPC disposal, which remains to be the key re-rating catalyst. We believe this could mark a turning point for the group by removing an estimate of 500 to 600 million ringgit annual earnings drags, which we have seen for the past few years. So materially, this will also reduce the FX volatility as PPC accounts for 95 to 96% of its USD denominated payables and improving the quality and predictability of the earnings. So the transaction could also strengthen its balance sheet and provide options for capital management. So this subjects to the final transaction structure. So as for now, we maintain our earnings forecast. Our unchanged TP of 5 ringgit and 92 cents is still based on a 1.3 times FY26 forecast of price to book value, which is 5-year, which is in line with the 5-year mean. So following the recent share price weakness, we believe the downside is largely priced in, while the potential PPC divestment provides an attractive re-rating catalyst here. Accordingly, we upgrade our stock rating to buy from neutral. So that's all from me. Thank you for watching Morning Kappa at 8, and we'll see you again tomorrow.